Corporate Finance Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel related to the calculation of return on assets, return on equity, and asset turnover. Get ready. It's time to take a chance with corporate finance. Here we are in Excel. We have our information on the left-hand side. We're going to put that into our blue area, into our worksheets on the right-hand side. We'll be calculating the return on assets, equity, return on equity, sales, profit margin percent, and we'll be using the assets turnover in order to calculate this sale. So what we want to do here as we go through these practice, working through these problems, understanding, memorizing some of the major calculations that we will be using, and then being able to interchange those calculations to look for certain amounts that will be included within each calculation or how they will be related. And that will help us with test questions, which is oftentimes going to ask us for questions to kind of back into certain numbers using these relationships. It will also, of course, help us within practice as we get a better understanding of these relationships and therefore have an actual understanding of what the ratios are telling us. So let's look at this information. We got the assets, we got the debt, we got the net income, asset turnover times per year. We'll start off with the asset turnover, so asset turnover ratio. And so what we're going to be comparing then is the net income to the assets here. Net income compared to the assets. Net income is going to be an income statement. That's the bottom line of the income statement, you'll recall. And this is kind of similar to the return on investment type of calculation we've seen in the past. We're saying, hey, look, this is our activity, how we're doing. And then the assets, when we're looking in the past, when we had the initial investment into a company, then those were the initial assets into the company. If the company is ongoing, of course, you could do a calculation comparing the net income performing compared to the assets, remembering that we have assets equals liabilities plus equity, or you can write that as assets minus liabilities equals equity. So assets represent what the company has, and we're going to compare that basically to net income, and it's kind of a comparison as to how efficiently the company is using then those assets. So we're going to say net income compared to the assets, and we're going to take the net income is going to be the 152. Now notice we're comparing something on the income statement to something on the balance sheet. Whenever that is the case, we have two kind of time period measurements that we're thinking about. So we're thinking about the income statement, which is typically going to be, which will be for a range of time, meaning an entire year. So an entire year of time, whereas the balance sheet, we're talking about a point in time. So in order to, we're always going to have this kind of reconciling item that we need to do in order to think about, well, how are we going to like combine these together to be comparing them when the two statements are talking about really two different time frames, right? One is where we stand and one is performance. So the income statement is how we did over the year. This is the balance sheet is where we stand at a point in time. So the return on assets may be reflected as the average. Oftentimes we'll pick the average asset. So anytime that's the case, where you have an income statement compared to the balance sheet, your suspicion is that it could be that they're asking for the average assets. Now, what does that mean? Well, we could take the traditional way to deal with average assets is to take the beginning assets at the beginning of the year, assets at the end of the year, add them together, divide by 2. That's still somewhat arbitrary because, again, we're just picking 2 points at the beginning and end of the year to try to average some type of number that we think would be reflective of the entire year. It could be that the assets varied a lot. It could be the total assets didn't vary that much. We're just going to be picking up the total assets given at this point, total assets here. But just realize that depending on how you're going to do this calculation, you got to determine what are they going to be asking for in the formula. Do they want, if you're doing a test question, do they want something that's going to be the average total assets in the denominator and make sure that you conform to whatever that conformity will be? And then when will that come up? When will this average thing come up? Pretty much any time you can have a comparison where you're comparing something that is an income statement account and then to something that is going to be a balance sheet account. And then in practice, then you're going to want to be thinking about in terms of what should I do in practice? What's the best thing to do for real life? The question is, well, what's going to be the most representative number? If you take the number on the balance sheet and you think that's a representative number of the time period or the whole year, then you can take that. If you wanted to get more complex in the average, you could take, the beginning and the end of the year, divide by 2, but you can also take other points in the year, right? You might take other points in the year and divide it by however many points that you decided to take. So just keep that in mind whenever you're comparing the income statement and the balance sheet type of number. We're going to divide that out. 152 divided by the 1,750,000. That's going to be our return on assets. So return on assets. Okay, and let's do some formatting here. We're going to make this a percent, home tab, numbers, percent. We'll add some decimals. We'll underline it. Notice you could add more decimals here, but we'll typically round it to 2 decimals out. If it's a test question, you got to make sure you're specific in terms of what they want in practice. You want to round it to what's relevant. Underline it there. We're going to put an underline here. Okay, now let's figure the equity. So now we know what the assets are and we know what the debt is. So we can figure equity by using simply the accounting equation, which is generally written as assets equal liabilities plus equity, which we can rewrite as assets minus liability equals equity, which is a useful way for people that are doing finance oftentimes because that emphasizes kind of the book value of the company, which would be represented by equity. So we're going to pick up then the assets. We're going to say the assets are going to be this 1750. We're going to be picking up the liabilities, and that's going to be the 686. Now we're talking about 2 accounts that are basically balance sheet accounts. So we're typically looking at the balance sheet, of course, which would simply be the end of the year. So we don't have this problem where we're comparing something from one time period to another time period, like an income statement range to the balance sheet. So of course we're not working with averages at this point in time. So I'm going to be subtracting these out. Assets minus the liabilities or debt, that's going to be our equity. So that's going to be our equity. Going to underline here. We're going to underline and double underline here. Okay, so then we've got the return on equity. So now that we have equity, we can calculate the return on equity. Now, what is equity? Equity is going to be, once again, assets minus liabilities equals equity, or in the terms of the accounting equation, assets equal liabilities plus equity. Assets is what the company has. The third-party claims are represented by the liabilities, and then the equity claims represent the owner's claim to the assets of the company. So we can represent that an asset minus liabilities is like the book value of the company. The book value, the amount that's allocated, amount of the assets that are allocated in essence or attributed to the owner. So we're going to take just the owner's portion of the equity then, which is the equity. And then we're going to be comparing that to, we're going to take the net income, the income statement number, the net income, pick it up over here, and then we're going to compare that to equity. So comparing that to equity. Now, once again, now you see we have an income account here, the 152, and we're comparing that to equity, a balance sheet account. So we have this timing kind of issue once again, because now we're comparing something that has a time frame, beginning and an end, 12 months or 1 month or whatever, and then the equity. So you might then see the equity then, people trying to conform that by using some type of average equity, which would typically be equity at the beginning of the year plus equity at the end of the year divided by 2. So if you see that formula, just note you're going to take the ending equity last year, and then you're going to take the ending equity this year and add them together, divide by 2. That's the most common type of way to do an estimate. But again, it's still just an estimate because we're picking just 2 points that are furthest apart in time, not necessarily in amount, and then dividing, taking an average of those 2 numbers. So then we're going to underline here, and then we're going to say that this is going to be return on equity. So we'll divide that out then. We're going to say this is going to be equal to the 152 divided by the equity. Let's make this a percent then. So we're going to make this a percent going up to the home tab, numbers, percent. We'll add some decimals there. So we got the 14.29, 14.29. Okay, so next we want to figure out, we're going to look for the profit margin percent we would like to get. In order to do so, we need to figure out the sales. So we're going to figure out the sales. Now, how do we do that? Well, what they gave us over here was the assets turnover. So they gave us the asset turnover. We can use that to calculate the sales. If we don't know exactly how to do that, you're going, well, I know the asset turnover. I think I can figure that out, but I can't really turn it around in my head algebraically to figure out how I would figure sales on it. Well, then you're going to just put your information into the total asset turnover, which is sales, which is the unknown. And I usually do it vertically first because this is how I would typically think of it first. And in a kind of a vertical format, my head doesn't think about it in a linear algebraic equation oftentimes. But I mean, I could. But I usually, it's easiest for me to think about it vertically like this. And then we're going to say assets, comparing this to the assets. So sales compared to the assets. And the sales is what we don't know. The assets we're going to be picking up at the 1,750,000. Once again, note that you're comparing something that is an income statement item, which is sales, compared to assets, a balance sheet item. Timing difference there, one being a range, one being a point in time. So therefore, you could have this average total assets depending on what questions or what's the formatting they're going to be asking you for the denominator. So, and again, the most common average, whenever that's the case, would be to take the beginning of the year number plus the ending of the year number and divide by 2. So just be aware that of that, anytime you have that difference between you're comparing an income statement number and a balance sheet number together. Okay, and that's going to give us the total assets turnover. So total assets turnover, but we know what it is. It's going to be 1.2 for us. So 1.2. Now I can write this down algebraically and do the algebra, which I'm going to write it down on. I would write it down on a piece of paper now, right? X. It's going to be x divided by the 175,000 is going to be equal to the 1.2, and then you could do the algebra. I won't do the algebra here, but I'll do it in kind of a vertical fashion. If you were to break this out algebraically here, we would say, all right, this is going to be then the assets times the turnover. So the total assets is going to be this, and the total asset turnover is going to be equal to the 1.2. And let's format this. Home tab, numbers group. We'll add a decimal. We'll put an underline under it. And that's going to give us our sales. Multiplying that out, this equals the 1,750 times the 1.2. Now, that would be basically doing the algebra, and then I put it in vertically. Now, the tendency would be for people to try to just see this in their head to calculate to use the total asset turnover to calculate sales. And they kind of think they should just be able to do that. And if you work with it enough, of course, you will be able to do that with but it's fine for a test question. It's fine in practice just to be able to say, well, I know the asset turnover, write down the algebra, and then figure it out from that point. That's perfectly fine. Let's do this over here now and do it with the goal seek. So let's use our goal seek and say, okay, let's see if we could figure this out this way. And I know I deleted it over here, but that's okay. Just it'll come back. I'm going to say this is going to be equal to the sales times the or divided by the assets. Okay, then I'm going to use the goal seek to kind of figure this out in Excel because I think that's good practice to be using the goal seek. So that's going to be under the data tab, the forecast, what if analysis, goal seek. And then we want to say, hey, change this cell, would you please, Excel, to 1.2 by adjusting this cell because they're related by formula. It'll do a trial and error to do that. And then it'll pick up, there it is, the 2,000,001. So there's the 2,000,001. Then we're going to do the profit margin we can now do because the profit margin, as we know, is going to be the net income. So we're going to be comparing the net income, which we have, say, up top, or we have right here. And now we have the sales, comparing that to sales. This time we're comparing income statement account to income statement account, or income statement line item to income statement line item. Therefore, we're dealing with the same time frame, being the year, January through December, if it's a fiscal year or a 12-month year or calendar year. And so we don't have to do an average type of thing. We don't have that issue of, do we need to do an average? Because we're not comparing an income statement to balance sheet item. So profit margin then is going to be equal to the 152 divided by the 2,000,001. Let's format that now. Go into the home tab. We're going to go to the numbers, make it a percent. We'll add some decimals there. We could double underline it if we so choose as well.